there, everyone. Today I have with me Justin Pierce Berutich, who's written a wonderful chapter for our treatise, upcoming treatise, and I'm going to let Justin introduce himself. So everyone remembers I'm one of the co-authors of our treatise, along with Andy Kramer. Justin, why don't you take it away?
Great, thanks, Nick. So as Nick mentioned, my team and I helped author one of the chapters in this treatise. I am the managing director and head of tax at Euclid Transactional, where I lead our team's insurance practice, helping develop bespoke commercial solutions to complex tax matters. I was in private practice for about 8 years before transitioning into this space in 2016, and I have been with Euclid Transactional since 2019.
That's great background. And so our treatise, Energy and Environmental Project Finance Law and Taxation, you like you said, you have a great chapter in here that I found very helpful. It's chapter 18 for everyone, and it's specifically on insuring renewable energy credits. But why don't you tell us, what is tax insurance?
Sure. Tax insurance is a risk mitigation tool for private equity, strategics, individuals, and virtually any other taxpayer should a tax position fail to qualify for its intended tax treatment.
And has tax insurance, it's obviously playing a new role with respect to these credits, right?
Correct. Tax insurance has been involved in renewable energy, going back years and years. It's really been energized by the Inflation Reduction Act and the introduction of transferability and direct pay.
And as a transactional lawyer, I always wonder what's the interplay between tax insurance and an indemnity, because we always in any tax credit transfer deal specifically, we try to negotiate a strong indemnity. But why can there be overlap between the two?
Sure. Tax insurance can fill multiple roles with respect to how it's going to interact with an indemnity. Sometimes tax equity investors or tax credit purchasers may not want to rely on the balance sheet of the sponsor developer. And that's where A-rated carriers, like the ones that provide us capacity, can step in and sort of provide a stronger position should any issues arise. Alternatively, sometimes sponsors, developers don't want to take on the indemnity risk. And so we can step in and either backstop that indemnity or in place that indemnity for the buyer or the tax credit or the lender in that scenario. Again, with A-rated carriers providing the support behind those coverage positions.
And I think that's a great segue into a discussion of why tax insurance matters. It sounds like it clearly fills a role in the marketplace. Why don't you give our readers here a little preview of why it matters?
Sure. So tax credit transactions are very complex. There's a lot of gray areas involved in these transactions. And that tax uncertainty is not just legal, right? If you're not complying with all the nuances of these laws, you're going to have a financial hit as well. That could be, lost credits, impairment to your financing. There's going to be requests for escrows. And these issues, impact the credits for tax equity investors, the price of those credits for tax credit buyers, and the viability for the sponsor and the developer. And we're able, as in tax credit insurers, to come in and help smooth out a lot of those negotiations, because they know that if there's an issue with those credits that they're seeking coverage for, that we will make the parties whole at the end of the day.
And could you explain to our readers, I mean, I think most people are familiar with how insurance works. Could you explain to them how tax credit insurance works, like the process and some of the key aspects of a policy?
Sure. Someone in the tax credit deal team is going to reach out to a tax insurance broker. That's a specialized broker that works specifically in the tax insurance area. They're going to help the taxpayer package together their project with the coverage that they need. That information comes to myself and competitors in the market that I work with, and we're going to review that. And if it meets our risk appetite, we're going to provide terms back to the broker, who will then work with the taxpayer for the parties to pick the market they would like to work with. Once we're formally engaged, we may ask for more specific documentation. We may get on the phone with the taxpayer and their advisors to ask a few questions. And once we finish what we call like our formal underwriting process and negotiate a bespoke policy, we're able to take that risk transfer on in exchange for a one-time premium payment.
And so, I always think these clients, they care the most about obviously the coverage, how much the premium costs, but also the like what's going to be a covered loss, and typical terms like I said, limits and premiums. But for the covered loss, there's usually a pretty significant negotiation between how what's considered covered by the policy and what's excluded, right?
I don't know if it's heavily negotiated. We want everyone to understand exactly the coverage they're getting and the coverage they're not getting, and that may vary across various providers and of insurance providers across the market. Some people may select just qualification coverage. Will my fair market value be respected in an investment tax credit project? Others may say, I want to ensure that the tax equity structure I'm putting into place will be respected. I also want the qualification coverage, and I'm also concerned about recapture on this project and want to ensure that any losses resulting from recapture are already covered. The IRA added some complexity with adders, and so now we're also being asked in certain instances to cover whether prevailing wage and apprenticeship requirements have been met, whether the energy community adder, the domestic content adder are going to be satisfied. And so we're able to cover all of those types of risks. And then we typically do have exclusions for material changes to the transaction documents without our consent after inception. Certain aspects of change in law, Euclid is prospective. Others exclude out all changes in law, which is typically limited just to the code and regulations. But when the IRA first came out, and there was a lot of notices coming out related to some of these adders, there were certain people who were saying, all right, we need to broaden our definition. So there's always a negotiation with the taxpayer and their advisors about what may cause a loss not to be covered under the policy.
And that's a good a bridge to talking about the key risks that are covered in a renewable energy policy. I think you covered pretty well there. Others that I think are probably worth mentioning. It really depends on the type of tax credit too, right? Like a 45X tax credit is going to be different than an investment tax credit because there's different risks associated with it.
That's correct. Yeah, we are able to cover a pretty wide gamut of different tax credits. We also can cover the transferability, components of that, whether the buyer and seller are both going to be respected. We can cover aspects related to the registration filing and the election filings to make sure that those are proper and will be respected as well.
And with some of the other risks, you mentioned transferability or direct pay. Obviously, there's and that the IRA changed a lot of this. There's obviously a legislative and guidance impact on this. So for things like transferability or direct pay, how important is it in the insurance markets for the IRS and Treasury to issue guidance on these topics so they can provide taxpayers with assurances, and then you, in your role with understanding what the rules are and what the risks are associated with the project?
Yeah, Euclid certainly believes, and I believe a lot of the market believes, that a well-funded and staffed Internal Revenue Service is good for all of us. The more resources that the IRS has, the quicker they can get notices and other guidance and regulations out to the taxpayers. The more information we can have, the better risks assessments we can make. There's still gray areas in all of these positions, but we'd rather know the tact that the IRS plans to take with certain risks. Like I'm sure you ran into this too. When the FEOC rules came out, then there was an executive order about how they were going to treat begun construction. And begun construction has obviously been around for decades in the renewable energy space, and we weren't certain whether this new notice was going to apply to all projects in all instances, and they were going to change past practice, whether it was just going to apply to these new FEOC rules or whether it was going to apply just to certain projects going forward. And then we finally got that notice that came out with respect to the new begun construction rules, and it wasn't really all that different than what we had been utilizing in the past. Obviously, there are some nuances to it. The 5% begun construction safe harbor isn't available to all projects like it used to be, but outside of that, it's pretty much as we had been operating, which was, I think, welcome news to everyone in the space.
Yeah, it was interesting too. The day that notice came out, I think it was about a week and a half ago on a Friday. I got a text in the afternoon from a friend who's a trader, and he said, what's going on in the solar market, because their stocks are shooting up," and that kind of signaled to me that, well, people must think this guidance isn't as bad as they thought it was going to be. But yeah, that's great. And I think with the IRA, you saw at the beginning days of it, like there was a lot of issues, like how could you underwrite prevailing wages, because we didn't really have guidance. And now with these new prohibited foreign entity rules, is it similar? These are rules, so our readers know that starting in 2026, if you're trying to claim an ITC, a PTC, or a 45X credit, there's restrictions on what are called prohibited foreign entities from claiming those credits. And then there's also restrictions on entities that receive material assistance from prohibited foreign entities. And we can't really get into the definition here because I think we could probably take up a whole one of these on it. But is given that there's no guidance yet out there, is this going to be a wait and see area to see how the insurance markets react?
I believe so. And without getting too nuanced on the issue, there's still a lot of projects that are qualifying without needing to comply with these FEOC rules. And that's a lot of what we're dealing with at the moment. Ones that FEOC may be applicable to, the parties to the tax credit transfer are determining who's going to bear that risk, because the insurance market without the guidance hasn't been able to get comfortable with it yet.
Yeah, I've seen a few transfer agreements already start to breach that subject of who's going to represent what and who's going to bear that risk. So I hear you on that. But it's like you said, it's newer. It's not for stuff that's began construction in 2024 or 2025 yet.
Correct.
So, we talked about the legislative impacts. There's a lot of new players in this space now because of the role of transferability now plays, and that it's an avenue. Have you seen an uptick in credit transfer insurance products or demand for those?
Yeah, I mean, so most tax equity investors were requiring tax insurance on most of their investments pre-IRA. Post-IRA, we're finding that almost all tax credit buyers, tax credit transferees, are requiring tax insurance. And whereas tax equity investors were willing to take certain risks, such as maybe the structure of the transaction being that they were the ones demanding the certain structures, the buyers who aren't necessarily familiar with tax credits, renewable tax credits at all, are coming in and saying, I want coverage for absolutely every possible risk that I can get. And I would like it to be, typically for the full amount of the credit and sometimes more. And so when that situation arises, there is a lot of demand for insurance. And so, yes, we have seen a very large uptick in the demand for the product since, I guess, 2023.
Yeah, I think that tracks with what I see. I think tax credit buyers, the structural items, like is the seller a partnership? How is recapture going to apply? Because that sometimes can be an exclusion for certain things related to recapture for an ITC deal. And then the adders, I think too, those are always tough to negotiate and or come to terms on. I think 2025, so prior to the last presidential election, the change in law, I didn't see that as that controversial or much of an issue. But I think, in his first week in office, when the new president issued that executive order, kind of giving a shot over the bow on energy, that to me was like a date where things changed. I was negotiating a large policy on that date, and it had a chilling effect on what um, parties would agree to or what's considered a change in law. So it's interesting to hear your perspective on that. I think maybe we can close with some thoughts on structuring for buyers and sellers. Like what do you typically see is important to a buyer versus a seller of credits? It's an odd. I always think of it that there's some, buyers and sellers of credits are obviously on the opposite side of a deal, but with the insurance policy, there's usually some um there's some commonality between them on those, because they obviously are both relying on it for different reasons. But is there some thoughts you could share on that?
Yeah, I think now that the market has evolved and we've gotten more comfortable with transfer structures and we've seen more tax credit transfer agreements, the policies have adapted. Almost all tax insurance policies covering renewable energy credits now include the buyer, the seller, and if there's a tax equity investor, all in one single policy. Um, we can do buy side only policies, we can do sell side only policies, but we're finding that almost everyone's interests are aligned, especially if it's not a full transfer of the credits. If the sponsor's only transferring 90% of the credits and retaining 10, they're going to want the coverage for their, retained credits. But even if they're not, if they're transferring 100% of the credits, they don't want any indemnity obligation to that buyer, and that buyer wants to make sure they're made whole should any of the credits not be respected. And so having them on one single policy has really been the most efficient means, because we'll have all the information from all the parties, everybody's party to one contract in the insurance space, just as they were with their tax credit transfer agreement. And we're able to address sort of everyone's needs in one document.
Yeah, I think that tracks to what I'm seeing as well. And are there any common tension points between buyers and sellers that insurance can help resolve? I think you mainly covered them with risk and with indemnities and with guarantees and things like that. But is there any other points you wanted to add?
Some of the tax credit buyers, Fortune 50, potentially publicly traded companies, are new to tax credit insurance. And so sometimes it's more of an education process with getting them to understand that us as tax credit insurers are going to need a seat at the table with respect to tax contests related to these credits. And so, advising them that they're not going to be able to settle a challenge to the credits without our consent, that we're going to require them to pursue any challenge by the service to the credits, through the tax court, potentially to the Court of Appeals, and then how we're going to deal with a claim that some of the credits may have been recaptured, and and how we're going to deal with those. While those, may be deemed tension points, I think when you're dealing with sophisticated parties and sophisticated lawyers, many of them are repeating themselves, as you know, Nick, right? Like, you're not only representing sellers on certain deals, but buyers on others and tax equity on others. And you're able to advise these people about how the product works. And once they understand that we're sort of all rowing in the same direction and that we all believe the tax credits are viable on the date of inception, we're able to come to an agreement about how to deal with these issues.
Yeah, I think especially with the tax contests, I think the terms that are sort of crystallizing in transfer agreements around what's acceptable and what's not, and from there, I think when you look at what's in the tax insurance policy, generally it all makes sense. Where you say, yeah, directionally, like you said, like this, if you're getting insurance on something, they're going to want some ability to monitor and have approval over things like settlements and how far you take an appeal and everything like that. And especially if it's covering contest costs as well.
Yeah. And I think one of the points that almost all policies have that makes taxpayers more comfortable is we'll put directly in our policy that the law firm that's representing them in the deal can continue to represent them should there be a contest that arises. We're not going to conflict anybody out, of those natures. Like those parties are still going to more or less drive any tax contest related to the credits, and the insurers are going to be in the background with notice and consent rights.
Absolutely. Well, this is super helpful. I think, like we said, this is chapter 18 in the treatise. I think it's a great chapter. I think it's very, it's very well written, very insightful into tax insurance and insuring renewable energy credits in particular. So, thank you, Justin, for adding it. And I think our readers, everything's in there for them to read and to know about and to learn about if they have any questions. It's a unique aspect of this book, and we're grateful for your contributions.
Yeah, our pleasure. Thank you very much, Nick.